Well, hello and welcome back to Jones Financial Talk. This is Nick Jones from Jones and Associates Premier Financial Solutions. Listeners, if you'd like more information about what you hear on this awesome radio showcast podcast today with Mr. Tony Shore, please give us a call at 541-500-4321 or just go to jonesfinancialtalk.com. You can request lots of information on our website, including going to that great radio page where Mr. Tony Shore and I do weekly shows. You can download the program, subscribe to them on Apple Podcasts, Spotify, and Amazon Music. Lots of great information there. Or just request information about what you'd like us to cover on our great show. What I think is our great show. Tony does too. He's looking at me kind of funny, but anyways, listeners, this week, we are getting so close to the 2024 presidential primary season. It's obviously started and we're going through the motions there. Many people are turning their attention to what the outcome of November's election is going to mean for their finances. And so that's what we're going to talk about in detail today. There's just so much information that I'm eager to share and talk to people about because there's just so many myths and realities actually that happen when you think about election outcomes and what they mean for your money. And so I want to be able to talk about that in detail. But before I do, Mr. Tony Shore, how are you doing today?
I am doing great, Nick. I'm having a good week. I've recovered from the Super Bowl. Enjoyed that. It was a little slow first half of defensive battle, but close game. I knew it would be. I think conventional wisdom thought KC could pull it out because of Mahomes, and they did. I was kind
Can't
of
give him too much time. I mean, he's just.
I know. He runs and he'll run for it if he needs to. I mean, they had him stopped a couple of times, and there he went, just shooting.
I was surprised. I was West Coast boy here. I'm definitely a 49er
I was
fan,
rooting for the Niners.
Disappointed.
Yeah, me too. I thought the Niners could do it. I always root for the underdog. I didn't have a horse in the race, and so I was rooting for the Niners. And people will say, "Oh, underdog." Everybody I talked to thought KC would win, and so I'm like, "No, I'm pulling for the Niners regardless because." I don't like it when teams win year after year, the same team. And so I wanted to see the Niners win, especially the young quarterback, right?
Yeah, definitely. And a very late draft pick, right?
He was the last draft pick. Wasn't it Brock the last draft pick? Yeah.
Like the sixth round, like 3 years ago. And now, boom, he's running the team.
Yeah, isn't that crazy? He's a talented kid. He's gonna go places, I think.
Definitely. Definitely.
Yeah. So did you watch the whole game? I bet you were disappointed at the end.
I was counting how many times they showed Taylor Swift like everybody else.
Oh, yeah. Yeah. Everybody played the Taylor Swift drinking game, I think, during that one. Did you flip over and watch the game at all on Nickelodeon? Did you see that?
No.
Oh my goodness. We watched about 10 minutes of Nickelodeon coverage. It was hilarious. It was so bad it was good. Completely, SpongeBob and Patrick were announcing live, like the voice people do. It was crazy. Like it was so funny. But yeah, I watched that for a few minutes just to entertain ourselves. But we mainly watched the main channel, of course. I couldn't make it all the way through the Nickelodeon. Some people are like, let's leave it on here. It's funny, but I had to turn away. They showed Taylor Swift more on the Nick coverage because they had different. It was they would show her in the box more.
Okay.
Yeah, so they had a different camera switcher for the main plays. Well, the plays were going. It was the same, but with effects and different announcers. But during the game and during breaks, it was completely different. I thought it was funny. I didn't know they were. I can't believe the NFL let them do that with the Super Bowl, but it was funny. But you've been busy there, I bet, with clients and things like that.
We sure have. Yep. Sure have. And there's lots of things that are happening, right now. This topic today is going to be great for us to talk about.
Sure.
It's interesting, Tony. There's always a couple of subjects that are out there on people's minds that give them kind of some anxiety about possibilities in their investments. And, most recently, we've had conflict in the Middle East and a possible recession, right? But now it's kind of pushed a little bit more to election anxiety, and there's been lots of studies that take place during this final year before the new president comes in. And there's all these different studies that take place and surveys, like, one that I was reading about actually just yesterday, that found that 68% of Republican investors think that the election's outcome is going to have an immediate and direct impact on their finances. And only about 57% of Democratic investors think that it will.
That's still the majority.
Totally the majority. And while that's perfectly understandable, that investors and savers will always feel anxious during election season. Historically, the trend suggests that there's going to be, very little reason to be concerned. And while, past isn't always the perfect predictor of the future, there's just tons of data that suggests that investors should feel very optimistic about what is going to happen with our upcoming election and what that really is going to mean for their bottom line and finances, because it's usually very, very positive, Tony.
Well, yeah. And so not only should investors not be worried about the outcome of the election as far as their money is concerned, they should also, in fact, be excited about it. That's interesting. You have me intrigued because I know a lot of people do worry how much is this going to affect the stock market? And history shows long-term presidential elections, no matter who wins, doesn't affect it long-term at all.
That's right. I mean, there's lots of data that's out there that tells us that, markets have generally risen during presidential election years.
Yeah.
And in fact, the most well-known index, the S&P 500, which everybody watches, has shown positive returns 20 of the last 24 election years going back to 1928. And
wow.
That's growth in just 83% of the time that there is a presidential election. So that's a lot, and as far as how much return we get in those election years, the average, right, was about 11.5%. And that's higher than typically we receive in just normal years on average in the S&P 500 of, say, 8 or 9%. And so, that just suggests that election years always make a big news story. And, I mean, we're choosing, obviously, the leader of a free world, and elections have historically had, just a modest bearing, actually, long term on what's going to happen with the economy and markets. But the year that we elect them has always typically been good.
Yeah, and I think if people aren't already working with you or a trusted financial services professional, I think you need to, because economic anxiety can cause you to make mistakes or improper decisions. And so it's good to reach out and have a plan in place and know that you're going to stick to that plan regardless. Presidents come and go, but the stock market over the last 100 years has risen. We've seen volatility during that. It drops, it rises, and everybody's plan and goals are different. So you need to meet with your financial professional and give Nick a call, get a second opinion on where you're at, get a plan in place, and you don't have to fret about the election affecting your finances. Lots of things affect finances. I mean, the week we're recording this show, just this past week, we've seen the S&P hit a record high, went over 5,000 for the first time ever. And then the next day, the next morning or that afternoon, then they announced, the inflation didn't go down like we thought it would. It stayed the same. It's about the same. And on that economic news, the market, there was a sell-off. So you see these ups and downs, right?
Yeah, and these splashy headlines are just things that you need to ignore when you think about different things that are occurring, because emotions, you don't want them to get in the way of your fundamental investment rules, right? You need to maintain focus on, the fundamentals that are occurring today and why things are happening, like, elevated interest rates and, moderating inflation. And you are correct. Is that actually happening? And if it is, how is that going to affect your long-term goals and what your portfolio is actually doing? I don't want, and it's always difficult to manage expectations from an emotional side when you're thinking about investing. And so you want to go back to the fundamentals. You want to stay away from, the jargon and the splashy headlines that can obviously just, derail those positive thoughts.
Right. And it reminds me of a British expression, which is steady on, right?
Yep.
You just steady on. And so when it comes to your finances, we should all stay steady on, right?
Yep.
And not get distracted by what history suggests isn't going to be that much or matter that much in the long run.
Yep. And if investing, Tony, is part of your financial strategy, which I'm sure it is for many people that are listening to the show, both today and in your retirement, if you're not there yet, it is, in my opinion, absolutely essential to work closely with somebody that is going to help coach you through these situations. I mean, investing can be very, very rewarding, but it can also be extremely risky. So you got to have somebody in your corner that's going to offer you some experience and advice during these specific times. And this is a very good example, right? I mean, we only have a presidential election every 4 years. And so you've got to think through the fundamentals that are happening in the market today and how you should position your investments to take advantage of things during these opportunities. And that's a big point of why you should be sitting down and meeting with your advisor on a regular basis.
Exactly. Now, Nick, can you give us a rundown on some of the things that jumped out to you while you were researching the economic impact of presidential elections?
Sure thing. Probably the number one thing that people ask me about when we talk about the specific topic, and interestingly enough, there's actually no evidence-based correlation between the political party holding the presidency and stock market returns at all, Tony. And no matter how much you may support one party or fear the other, the data suggests that companies typically find ways to make money and produce positive returns no matter who's in office. And another big point is that the stock market has been consistently, positive since 1926. With only a few major blips like the Great Depression in the 30s, the tech bubble burst in the early 2000s, the Great Financial Crisis, that ran from maybe 2007, 2009, and then COVID. And so, the last point I'd make here is your behavior, and not election results, but your behavior is far more likely to determine what your portfolio's performance is going to be in the long term when things like this happen.
Yeah, and I think that makes a great point. You make a great point there, I should say. But our listeners will probably have questions. We have a lot more show yet to come, but let's take a moment here, Nick, to let our listeners know how they can get a hold of you.
Sure thing. Two main ways, listeners. You can give us a call at 541-500-4321 or go to our website at jonesfinancialtalk.com to request any information on there that you'd like to talk to us about.
All right. Sounds good. And listeners, make sure you give Nick a call, set up that no-charge consultation. Nick, you've got a great staff there at Jones & Associates, and you cover the whole picture from healthcare and Medicare, Social Security, investments, retirement income planning. It's all so important. Again, that number is 541-500-4321. And this has been a great conversation so far. We've been talking about the upcoming presidential election and how fears that the result of elections bring economic turmoil. And they're often overblown, is what you're saying, if you look at history. And that's according to the historical data. So what do you have for us next? What's next on the agenda, Nick?
Yep. So lots more stats to kind of back up exactly what we're discussing today, Tony.
Okay.
There's lots of studies that are out there. And one recently, found that 45% of investors think that the outcome of the November election is going to have a larger impact on their retirement goals and portfolios than market performance. Think of that, and so almost half the people think that whatever the outcome of this election is going to have a larger impact on their retirement goals and portfolios rather than just market performance. And so, pessimism, pessimism about election results often means for retirement planning, anxiety and the potential for new policies and an opposing party to come in, to maybe derail the U.S. economy can always have an opportunity to do that. But the pessimism around it is what happens, right?
Yeah. And the news media doesn't help, as you mentioned.
They don't.
Earlier.
There's, what positive news sells?
It doesn't.
Hardly any, right? I mean, it's always negative news.
The sky is always falling if you read the headlines, and it doesn't matter if you even reliable outputs like the Wall Street Journal or the Times or whichever news channel you choose to listen to, they all lead with the most disturbing or shocking, and it's always the glass is half full, it's not half empty. So
That's right.
yeah,
That's right. Now, there are some specific points that will be covered in this election that could have some dramatic effects
sure,
on the markets, clearly, and obviously in people's retirement planning. Let me give you an example. The biggest thing that's going to probably happen after the new president is elected or the current president is reelected, however that's going to work, is that taxes are going to change drastically in
yeah,
2025 because of the sunset rules. And so that is something that is definitely warranted and a big thing that we're going to have to follow and watch. It'll be interesting to see if that is a main topic in all of the debates that will take place between now and November.
yeah. I would agree. There are things, but people need to make sure. Even that, they just need to have a solid plan in place. And I know you're keeping an eye on these things for your clients, but they shouldn't get emotional and make emotional decisions based on who wins the election or who might win the election, right? I mean,
Yeah.
that's crazy to do that. And that's why you work with a financial professional, correct?
Yep. Yep, definitely. And I think that what happens for a lot of people is they're in a specific group, maybe it's with age or friends that talk to each other, and that can have some negative implications as well. If you're not doing all the research for yourself and you're just listening to what other people are saying, it's difficult to get the truth, and so when you're in retirement, there's lots of things that are going to be concerns. For instance, right now, about 41% of investors overall are worried about a recession still. Okay.
Still, yeah.
Inflation concerns are still really something that's similar. I mean, 66% of both retirees and near retirees are concerning, or expressing concerns about that. But and here's an interesting point. I mean, this is just happening as we're doing the show, Tony. You're correct. The market was hitting an all-time high earlier this week, and now all of a sudden, boom, we had a huge pullback. Because why? Because inflation expectations are positive, actually.
Yeah, they
And
were.
so
They were slightly positive, but they thought they would be, they thought they would be even better and should have dropped more. So,
right, and so it's
right?
always we're pricing everything in way ahead of time, right? And
Yeah.
so I mean, if the Federal Reserve is going to cut rates in March or in May or in June, does it really matter? I mean, clearly we know the direction that we're going to go in. And the point I'm trying to make is they're just trying to get it right and make sure that they're moderating this correctly. And if they don't do it correctly, we're going to be in a situation where it's going to be reversed. So the point I'm trying to make is don't listen to all the noise that's out there. Do the research, make sure you're talking to your financial advisor about it. My wife always makes fun of me and says stuff like this, but it's like, is it fortunate or unfortunate that he reads so much about the markets and the economy? It's
Right.
so
Yeah.
it's fortunate for my
Yeah.
clients, right? It's unfortunate for other things that I could do in my life, but I
Yeah.
love it. And that's the point. The point is things change so quickly. You've got to do the research, you've got to understand it, and you've got to be able to make sure that you take it and then do what with it. Talk to your advisor and make
Yeah.
sure that the investments that you currently have are still adequate for what you're trying to do.
Yeah, don't try to be a DIYer and do it yourself.
It can
Go
make
to a
things difficult, especially now. I
yeah.
just recently sat down with a couple of prospects that literally went to cash after 2022 and have been sitting there in cash this whole time, and they
Wow.
missed a huge rebound.
Yeah.
And so that's a specific point. You have to have a strategy and understand how that strategy is going to withhold up over a long period of
Yeah.
time.
So they sold low and they'll probably end up buying back in high.
Unfortunately.
Yeah, that's not good. Yeah, you want to yeah. Yeah, we're going to have bumps. I mean, there are years like 2022 and inflation skyrocketed, the market tanked, bad year. And so now people are thinking, well, inflation's terrible because things are still expensive.
Yep.
Things never go down. That's the way it is. But hey, I'll take 3% inflation over, 9.
Yep.
Right.
Well,
I mean,
and then also specifically like right now, Tony, some other stats that are just boggling to me, 33% or a third of retirees are telling us today that they're going to become more conservative because of what they think is going to happen in November.
oh,
Um,
yeah.
and then on the flip side, only about 15% of people are saying they're going to become more aggressive leading up to election day. And so there's lots of little data points that are interesting
It's interesting,
in
isn't
our
it?
world. And you know how they say, like, if most people are going in one direction, what should you do? Go the opposite direction, and you'll probably see better returns. Sometimes that's true. Like, this year, if you're going to take all of the money that you've had in the market and become much more conservative, what's going to happen when there's actually some positives that occur as a result of economic factors that are already pent up for us? And maybe the outcome of the election serves to be a great thing. And then, boom, we had a huge market run that you missed again.
Yeah.
There are ways for you to stay invested in the market and still be protected.
Yeah.
Lots of ways. And so I'm not suggesting you should take more risk. I'm not suggesting you should go crazy. What I'm saying is, if you're working with the right people and understanding what's actually available out there, there's lots and lots of things that you can do to take advantage of upside market appreciation and still be protected.
Yeah. Yeah, I mean, there's gonna be big ups and big downs, just like there were this week, and the election might cause a big up or a big down. It'll probably cause both, and probably within a small, short time frame. So, uh, why would you be worried about that? I mean, nowadays somebody sneezes in China
Yep.
and it affects the market, right?
Yep.
I mean, that's kind of crazy. Or the Fed makes a statement and it affects the market one way or the other. And the Fed's just speculating, or they say, we're going to watch it, we're going to hold steady, or we're going to watch it. We may lower rates this year. Boom, the market reacts,
Yep.
right? But unless you're like, this is the year I need to take a bunch of money out of the market, unless your time has come, then you really need a strategy with a financial advisor. But if you have 5 years left, what do doesn't matter. The election this year doesn't matter
Well, and a huge part of what I wanted to
to
discuss
your
today.
to your portfolio or the market. That's
That's
what
right.
I'm trying to say. I mean,
And
elections matter. You you need to vote, and it'll matter, but not
but
to
don't
the
take your
market.
eye off the ball, I think, is part of the thing that you're trying to mention here, Tony. And
Yeah,
if you think about it, reposition your portfolio on a regular basis to take advantage of whatever's happening is the key. That's the key to long-term performance. I'm telling you. I've been doing this long enough and I've seen all the different ways to accomplish this. There are so many new solutions today that are available and great things that you can do to lock yourself in for specific reasons to specific investments to set yourself up. I mean, we are probably on the cusp of the highest part of the interest rate curve that we're going to see.
yeah,
So if you're not talking about locking in some good rates for a longer period of time, I've heard about people that call me and ask, "Hey, I got a local CD offer from a bank at 4% for 6 months, or they're going to give me 5% for 2 months." I'm like, 2 months, 4 months, 6 months. Like, how can you be that short sighted?
yeah,
Right. I mean, I actually have solutions available that'll pay you 6% guaranteed for 5 years. So if you really want to lock in a rate for a long period of time,
sure,
like, pick up the phone and call me.
yeah,
The banks know that rates are going down, which is why they're going to only offer you a
yeah.
3%, 4%, 5% CD for 2, 3, 4, 5,
Yeah,
6 months.
yeah. Just over a year ago, my dad inherited some money from his father, my grandpa, who passed away. It wasn't a huge sum, but he said I should put it in a CD. And we looked at CDs, and the only way to get a rate above 3%, like to get 4 or 5%, the longest term at that time even was 17 months.
Yeah.
Now it's less,
It's not
right?
even close to that. You're
Yeah,
going to find
yeah,
maybe 9 months
but
at the
but at
longest.
that time, if you used a MYGA, or there were other vehicles that you could use, put that money in where your principal's still guaranteed,
Yep.
and you could lock in that same rate, or even maybe a little bit better rate for a longer period of time. Now, if you're going to need that money in 17 months, don't put it in a 5-year vehicle.
Sure.
Right. But it depends on your goals, and everybody's situation is different. It's not like one is the bad, like never put any money in a CD or never put any money in a vehicle that's going to last 5 years. No, you have to look at what is this money for? And if it's for retirement, you shouldn't touch it before you retire anyway. So if you've got more than 5 years before retirement, put it in that 5-year vehicle to earn the money, and the market can do whatever it wants, and interest rates can do whatever they want, and then you're going to make that guaranteed amount in that term.
Well, and then the flip of that is this, Tony. A lot of people say, okay, Nick, I've been listening to your show. I understand what you're telling me. When the market is when there's economic turmoil or when there's noise that's out there like an election, how do I stay the course in the market when there is the possibility of it going down? And I'm like, well, there's lots of ways. So what if I told you I've got opportunities that would give you the ability to still participate if the market went up to, say, let's say 15 or 20%, but it's 100% protected from loss if the market goes down in the next 18 months. And they're like, what? There's lots of things that are relevant and available to help protect
buffered index portfolios with principal protection, something like that. And these things weren't always around. I mean, the companies are getting competitive, and investment firms, they're coming up with new ways because that's what people are looking for right now. And so they want to be able to have access to your money for the next 17 months.
What's interesting is we've
had longer, and
we've had just a crazy economic cycle and a crazy stock market for the last 2 or 3 years. And when I sit down with new prospects that show me what they own, I always give them a report, show them what they own, what they've paid expense wise, and how much risk they're taking, obviously. And part of that process, Tony, is when's the last time you sat down with your advisor? And they'll say, well, the reason why I'm sitting in front of you is because I haven't sat with my advisor in a year or 2 years or 3 years. And I go, well, I know that. And I could tell them that before they even answer the question. And they're like, well, how did you know that? And I said, because the investments that you own today are something you wanted to own 2 or 3 years ago, but you don't want to own them today. Yeah. What do you mean? Why don't I own them? Well, it depends on the economic cycle and what's going on. What is available today? You can make no guarantees in my business, but the guarantee I'll make to anybody today is if I sit down with them and give them a recommendation, they're not going to own what they own today in a year, 2 years, 3 years. If you're being active and if you're actually watching people's money and you're actually figuring out what's going on with the economy and with the markets, that just doesn't happen in this environment.
You have to have an actively managed portfolio.
Definitely. Yeah. Definitely. And I'm not trying to say don't stay the course. That's totally different, right? Stay the course and continue to invest, but put yourself in the best situation you can on a regular basis to have the least amount of risk and get the best return for that. And you can't do that if you just own the same thing for many, many years.
Yeah, okay. That would be like if my grandparents still had their money, if my grandmother still had all her money in Kodak and Sears. It's like, yeah, that does. Yeah,
she totally. You owned Kodak forever until it went belly up and nobody, has a camera anymore or whatever, right? I mean, it's, and so everything goes and ebbs and flows in different time periods. Right now, clearly, technology is huge, and everybody feels like it's a great investment. But we could have a crazy downturn and. Everybody in Silicon Valley could just start cutting jobs like crazy, and then we could have a crazy downturn just in that one specific sector.
Yeah, so we saw that sector do that in 2022.
Yep. So talk to people about it. Talk to your advisor about it. Push them. Ask them. The most astute clients I have are the ones that ask me, "What changes are we making, and why are we making them?" And if I say we're never making a change, or if I can't explain why we should or why we shouldn't, then I would expect that they would talk to somebody else, quite frankly, and so
agreed.
That's the point.
Yeah. Well, you know what? We're out of time for today's show. It just flew by, Nick. Great topic, though. Before we go, let our listeners know how they can get a hold of you.
Sure thing. Just a couple of different ways, listeners. You can go to jonesfinancialtalk.com and click on our radio page. You can also just request any information on our website on that page that you want to talk to us about. Or if you're local here in the Rogue Valley, pick up the phone. Give us a call. 541-500-4321.
All right. Well, thanks, Nick, and listeners. Thanks for tuning in. That does it for today's episode of Jones Financial Talk.